A very warm welcome to this presentation of our annual report. You know that with this report we try to contribute to the debate with policymakers, with academics, with the private sector about the global economy. We try to bring to this discussion a medium-term perspective that allow us to look into the underlying trends, the underlying factors that are driving the economy. Before I start this presentation, I would like to say a few words on the EU referendum in the United Kingdom and the outcome of which that has resulted in high volatility in financial markets. As you probably have seen, yesterday the central bank governors met in the global economy meeting chaired by Agustín Carstens, and they published a press release where they emphasize that governors endorse the contingency measures put in place by the Bank of England, and also emphasized the preparedness of central banks to support the proper functioning of financial markets. Moreover, they will continue to monitor, we all will continue to monitor the functioning and the stability of financial markets and cooperate closely. I think this is a very important statement. Central banks have acted swiftly in the past when it was necessary, when there was distortions in markets, and they have the tools and they are ready to act if this is necessary. Perhaps I would like to add that the fact that over the past few years private banks have worked heavily within the reform agenda to strengthen their capital and their liquidity buffers is also a significant improvement, and that it would be very different if this would not have occurred. There will be some periods of uncertainty and adjustment. It's certainly the UK is a closely integrated economy, a very important economy that hosts one of the most important financial centers. But again, as the communique was emphasizing, with good cooperation at global level, I am confident that the uncertainty can be contained and that the adjustment can proceed as smooth as possible. So let me come back to the annual report. Again, it is a more medium-term perspective, but I think this medium-term perspective is very relevant, is very important to deal with shocks, to deal effectively with shocks, and importantly, with the interaction of shocks and accumulated vulnerabilities. One of the first topics that we cover in the annual report is the realignment that has been taken place in the global economy, even before the UK referendum, a process that now faces the additional challenge coming from that. I will also talk about the increasing level of risks that have built over time, and some of the priorities of policy priorities in light of the rebalancing of policies that we are recommending. And here the main point is that monetary policy will have to be supported by prudential, fiscal, and structural reform policies. After my presentation, Claudio Borio, the head of the Monetary and Economic Department, and Hyun Son Shin, economic advisor and head of research, will elaborate on some of these specific points. So let me first talk about the realignment. Since the time of our previous annual meeting during last year, the world economy has kept growing, and in fact, with some measures, it has done better than some of the perceptions or even rhetoric suggests. It is true that global growth remained below pre-crisis benchmarks. However, when adjusted for demographic trends, it is slightly above long-term averages. Moreover, job creation has also been fairly strong in many countries, and a number of the large economies are actually growing above potential. At the same time, the world economy conveys a sense of unfinished adjustment and fragile confidence. Interest rates have fallen even further. The share of outstanding bonds trading at negative yields reached new highs. Even before the recent market disturbances of the past few days, we had already had a period of significant exchange rates and commodity prices movements. And all these developments can be seen as part of an ongoing realignment in the global economy that became more evident last year. And in the annual report, we argue that these realignments reflects the interaction of several long-term underlying forces. And I would like to elaborate on that. Since the financial crisis, we have seen a rotation of financial booms and busts. In the advanced economies at the heart of the crisis, the private sector slowly started to deleverage. At the same time, leverage picked up elsewhere, and signs of unsustainable financial booms began to appear, especially in some emerging market economies. And in these places, the pattern was similar to the previous cases, credit and property prices increasing strongly, supported by foreign currency borrowing. Exchange rates movements and commodity prices help drive this trend. They are very important in these trends, and the dynamics are known. Strong economic growth in more energy-intensive emerging economies pushed commodity prices higher. Higher prices, in turn, reinforced financial booms. Stronger currencies made the corporate balance sheet in emerging economies look stronger and reduce credit risk premia. And in this kind of environment, in an environment of ample global liquidity, borrowing, particularly in US dollar, became very easy and very cheap. In the annual report, we analyzed the so-called risk-taking channel of exchange rates in some more detail, and Hyun-Shin will talk about that later. But the point here is that over the past year, these various elements have begun to reverse. Domestic financial cycles have been maturing in a number of emerging economies. Growth has slowed somehow. Commodity prices have fallen, and the US dollar appreciation, supported by actual and expected US monetary policy, tightened financial conditions, particularly for those who had borrowed heavily in foreign currency, in US dollar. And these shifts in market conditions interact with the vulnerabilities that have accumulated over time. So let me now introduce the main sources of risk that we see in the global economy. We call it in the annual report the risky trinity. We analyze three basic sources of risk, and financial cycles are a common driver behind these three elements. The first is rising debt levels, both private debt, mainly in emerging markets, and public debt in advanced economies. We have said that many times. I would not go further than that. The second is important, is lower productivity growth. A number of reasons behind these low figures of productivity growth. We know that this is a complex phenomenon, but we have also argued last year and this year that financial booms allocate too many resources into expanding low productivity growth sectors, like, for example, construction. Once the burst occurs, it takes time for this resource misallocation to shift back to more productive uses. Our analysis indicates that these effects can be significant and, most importantly, can be persistent after the busts of the cycle. So the cycles have to do with some of the low productivity growth that we have seen, and the combination of low productivity and higher levels of debt is something that we have to look at. And the third factor is diminishing room for policy maneuver. This results in part from asymmetric and unbalanced policy responses. Policies do not lean against the credit booms, or had not leaned enough, but it has eased persistently during the bust. So this risky trinity has in turn given rise to three main threats. One is economic instability because of the maturing financial cycles and tighter global liquidity. We saw some episodes of this last year and early this year when foreign currency borrowing by emerging markets economies peaked and credit growth tightened. These episodes of stress and market volatility indicate that some of this underlying vulnerability persist. It is true, and it's to be sure, emerging market economies today are significantly more resilient to external developments. They have stronger macroeconomic frameworks, better financial infrastructure and regulatory arrangements, and more flexible exchange rate coupled with large foreign reserves. But it is also true that debt has increased much more than in the past in these economies. And now these economies have a greater weight in the global economy, and they are more tightly integrated. And this means that any strains in emerging economies will have a bigger global impact than it had in the past. The second threat concerns the persistence of exceptionally low interest rates. Again, we have talked many times about that. Let me just emphasize a couple of points. These low for long tend to depress risk premia and stretch asset valuations, and by implication, the prices of assets may become much more vulnerable to a snapback. The second point is that persistent low or even negative rates erode banks' lending margins, create more return mismatches for insurance companies, and boost the value of pension fund liabilities. The point here is that over time, all this can have a debilitating impact on the real economy. I would say that on top of that, negative rates can shake confidence and affect saving and investment behaviors in ways that are hard to predict and we need to analyze further. As the room for maneuver narrows, the third threat is a loss of confidence in policymaking and realistic expectations about growth, and the ability of present unbalanced combination of policies to lift global growth can create disappointment and weaken confidence. So the question is what to do now? And our answer is that there is a need to rebalance policies in order to shift to a more robust growth and sustainable global growth, and to address also the accumulated vulnerabilities. Now, rebalancing requires that prudential policies, structural policies, fiscal policies take a more prominent role. New shocks hitting the economy or the financial system do not fundamentally change the need for this rebalancing. These shocks may make it more difficult or more complex to carry out, but perhaps they make it even more necessary. From a medium and long-term perspective, rebalancing also requires a coherent macro-financial policy framework, one that systematically incorporates financial stability considerations in the analysis and in policy making. And we all know that developing this framework is very difficult. It will take time. In this year's annual report, we try to contribute with a few analytical elements and discusses also the priorities for current policies. So I will focus in my remarks on prudential, fiscal, and monetary policies. This is not to say that the importance of structural reforms has diminished. On the contrary, these are more and more important, and these reforms can contribute to productivity gains and can add flexibility to the reallocation of resources that I was talking about. But these are very country-specific, and we have addressed this on other occasions. So I will concentrate on these policies. First, prudential. For prudential policy, a lot has been done. I would highlight that the main priority here is to finalize the Basel III framework and devote more resources to the consistent implementation and more proactive supervision and careful monitoring of the consequences of the reform. I think minimum capital requirements have been raised significantly to reasonable levels. The critical point there is therefore to conclude the work ensuring that capital reflects the underlying risks. I think in public debates we tend to underestimate how much all the regulatory agenda can support the economy. A strong capital position goes hand in hand with more credit and, more importantly, more robust liquidity. And I think Hyun Shin will talk about these topics in a minute. Strong balance sheets on the financial system would allow financial institutions also to focus on other challenges that lie ahead, important challenges, restoring confidence and managing, for example, technological change. As a conclusion of that, there is a second priority, which is that in countries that were hit by the financial crisis, this calls for completing the balance sheet repair and restoring the basis for sustainable bank profitability. And in those countries where the financial booms are more advanced, taking early action is essential to strengthen defenses. Let me move to monetary policy. For monetary policy, the persistence of exceptional accommodation continues to raise important issues. We analyze in the annual report one particular issue, which is the stubbornly low inflation despite the unprecedented central bank actions. We argue that in addition to the low oil prices, very near-term factors, and cyclical factors, low inflation partly reflects positive secular supply-side developments that have weakened the link between inflation and domestic slack. The spreading of global value chains is one example that we analyze in the report. A product such as a simple smartphone may contain parts sourced from many countries and assembled in different locations. And the implication of that is that cost-cutting innovation at the global level is transmitted very quickly, more quickly to domestic prices. This is positive. This is positive for consumers, but it may contribute to inflation that remains below central bank numerical targets. This year, also in this area, we contribute to further analysis to the debate on how to think about leaning against the wind for monetary policy and also about equilibrium interest rates. This work suggests that there are significant gains from adopting a policy framework that takes financial stability systematically into account. And the emphasis is on systematically, meaning in booms and in busts, continuously, not just occasionally, when signs of unsustainable financial booms may become evident. Claudio Borio will elaborate on some of these issues in his presentation. For fiscal policy, trying to strengthen the foundation for sustainable growth requires actions that are very targeting actions, while avoiding destabilizing debt dynamics. The question about how much room for maneuver exists, what is the fiscal space, is an important question for fiscal policy. In emerging markets, fiscal positions have weakened substantially, especially for commodity exporters. And in advanced economies, current interest rates provide relief to budgets, but the uncertainty about fiscal space looms large. We illustrate in the annual report how much these estimates of fiscal space can vary, can diverge. And these uncertainties surrounding this calculation, these estimations, call for a very prudent interpretation of fiscal space. Getting too close to the limits may trigger a loss of market confidence that may be hard to reverse. There are, however, a number of positive steps that fiscal policy could take. One is improvement in the quality of public spending by shifting the balance from current transfers to physical and human capital investment. Another is to carry out needed infrastructure investments where proper governance is in place. And yet another crucial step would be to support, when necessary, balance sheet repair, and importantly, to complement, to help structural reforms. Beyond this consideration, it is also important to think of fiscal policy also as a part of a macro financial stability framework. And we dedicate a chapter in the annual report to this topic. The link between fiscal policy and financial stability is important and goes in both directions. On the one hand, protecting the sovereign from financial cycles requires incorporating the effects of financial booms into the financial positions when you estimate the financial positions. For example, rising tax revenues during a housing market boom should not be interpreted as a permanent improvement in fiscal positions. But it goes also in the other direction. Weak public finances can have a substantial impact on financial stability. The sovereign exposures of banks are often large, and the result may be an adverse feedback loop between the sovereign and banks in times of stress. A more balanced prudential approach in relation to sovereigns, recognizing the risky nature of public debt, would mitigate this feedback loop and provide a signal that no asset should be considered truly default-free. So let me conclude with a few remarks, I would say, in defense of central banking. The rebalancing of policies and improvements to frameworks carry high stakes for central banks. The past few years have confirmed how indispensable this institution has become. Independence and have allowed central banks to act within their mandates with determination to cope with the financial crisis. The determination was critical in the past for putting the global economy on the path to recovery. But the extraordinary burden placed on the institution since the crisis is generating growing strains. Market and the public at large have increased their dependence and the expectations about what central bank can do. And the wish list has become quite long. Restore full employment, ensure sustained growth, preserve price stability, and deliver a foolproof financial system. All this together is a tall order, and central banks alone cannot deliver on it. Indeed, the extraordinary measures taken to stimulate the global economy have sometimes tested the boundaries of this institution. The line between monetary and fiscal measures have become increasingly blurred. Central bank functions best if they focus on their area of competence and excellence, achieving monetary and financial stability. So more realism in clarity about what central banks can and cannot achieve will help them focus on this area. An institutional framework that clearly delineates their responsibilities from those of other policy makers is an important element. Monetary policy certainly needs to work alongside prudential, fiscal, and structural policy as part of this rebalancing that we are calling for, and in that sense, central bank independence, backed by transparency and accountability, remains today as crucial as ever. Thank you very much.